The Dow Jones Industrial Average has achieved a historic close above 50,000, but beneath the surface of this blue chip rally, the Magnificent Seven are undergoing a brutal fragmentation. We are no longer in an every tech stock is a winner environment. Institutional sentiment has officially hit a reality wall as the era of asset-light growth is being replaced by an asset-heavy silicon and steel roadmap. On one side, we see infrastructure dominance. Alphabet is riding a 48% surge in cloud revenue and a $240 billion backlog. On the other, we see a strategic retreat. Apple is now paying Google an estimated $1 billion annually to license Gemini 3 for Siri, effectively conceding the proprietary foundation model race. The market is now aggressively distinguishing between those providing the AI factories and those facing an expanding monetization gap. The primary catalyst for today's market volatility is the staggering $200 billion capital expenditure guidance issued by Amazon for fiscal 2026. This is the largest single-year investment commitment in corporate history, representing a 54% increase over 2025. Despite beating revenue estimates with $213.39 billion in Q4, Amazon was penalized for a marginal 1-cent EPS miss, reporting $1.95 against the expected $1.97, as investors fret over free cash flow depletion. Alphabet followed suit, resetting the bar with a guidance range of $175 billion to $185 billion, nearly doubling its 2025 investment. Across the hyperscalers, Amazon, Alphabet, Meta, and Microsoft, total projected capex for 2026 now exceeds $600 billion. This build-out is increasingly debt-funded. We expect the hyperscalers to issue between $250 billion and $300 billion in investment-grade bonds this year alone, including massive structured finance deals like the $30 billion Beignet bond for Meta's Louisiana data center infrastructure. Our 5-year outlook suggests that power is the new capital. We are rapidly approaching a gigawatt ceiling where access to the utility grid will dictate market leadership more than cash reserves. Data center power consumption is projected to jump 175% by 2030, transforming these tech giants into something resembling high-tech utilities. NVIDIA's Jensen Huang maintains that this build-out has a 7 to 8 year runway, but the AI payback clock is ticking. The winners of 2030 will be those who successfully transition to an agent-as-a-service economy. As AI models become the new operating systems, we expect a winner-takes-most dynamic characterized by mega-alliances like the Apple-Google partnership, which creates self-reinforcing scale that makes entry for smaller players nearly impossible. The divergence within the Magnificent Seven is just beginning. In a market defined by K-shaped instability, broad index exposure is a risk, not a strategy. If you enjoyed what you heard this morning and want notifications of this morning analysis every day, please hit that subscribe button. We'll see you at the opening bell.